Yeah, I think so. I mean, some of the parallels are, in a sporting sense, no one's ever played the perfect game. So football is a game of mistakes, and you often see young players make a mistake and spend the rest of their game reviewing it and just sort of get paralysed analysing that mistake. And investing's got some similarities with that. No one except sort of Twitter influencers sell at the very top. No one buys at the very bottom. There's always something left on the table somewhere, or an opportunity that's been missed, or a crap opportunity that's been purchased. But, if you perseverate on those mistakes, you sort of miss the next opportunity that's staring you in the face.
Hello everyone and welcome to a new episode of Conversation with Leaders. I'm Josh Gilbert, a market analyst here at eToro, and it's great to be your host for today. Before we start, a quick reminder to like, comment and subscribe to our channel. There is plenty of content to keep you up to date with, and we will keep giving you that information as long as you're subscribed. Today, we're joined by Chris Judd, highly regarded as one of the best AFL players of the modern day, with over 279 appearances over a 14-year career that included winning the league's highest honour, the Brownlow Medal, twice, as well as being selected for the All-Australian team 6 times and captaining them and both the West Coast Eagles and Carlton. Chris transitioned to working as a VC analyst before launching the Serity Macro Fund in 2023. Throughout this episode, we'll get a taste of the top moments of his career, his best investments, the current macro picture, and how to navigate the current environment. Chris, thanks for joining us today. How are you doing first and foremost? Good. Yeah, it's great to have you with us. Look, we can't get started without talking about your AFL career first. What a career it was. We went through some of it there. We mentioned the All-Australian, the Brownlow medals. What were some of the most memorable moments from the career, and how do you think they shaped you as you are today?
Oh, look, I had a really fortunate career. I was surrounded by a lot of great players and a lot of great people. In terms of career highlights, probably at West Coast, we were good enough to win the premiership in 2006, and that sort of stands head and shoulders above all the other highlights because it just requires so many moving parts to work for that to happen. As a player, you particularly as time goes on, you become acutely aware that you really are just one small cog in a much bigger organisation, and for teams that are able to win a premiership, it means that the administration, the fan engagement, the players, the coaches are all so well aligned and all working in unison at such a level that you're able to achieve the ultimate goal. So that was a huge moment and something I dreamed of as a kid. So to tick that off as a 23-year-old at West Coast with a great group of players was wildly special.
Yeah, absolutely. And I guess, like you say, not many people get to always sort of live out their dreams. So to do that is always going to be pretty special. I wanted to sort of ask you a little bit about that sort of transition from, being a footy player into sort of finance and if that was sort of difficult or was investing always sort of an interest for you? Because I think when we look at sort of some athletes, they only begin to sort of really appreciate the importance of investing later in their careers. Was that a similar case for you?
I was investing all through my footy career. Early days, I'd say, with a really low level of sophistication, and then towards the end of my career, it started to invest, with a few more systems in place and did a better job of it. But what was always really important for me was that I was building up a skill set that I could use for post-football. I hated the idea of just relying on people, for investment advice and other aspects, knowing that there was going to come a time when I would need to fend for myself and understand how the world works. So that was a real focus area of mine whilst I was playing football, for sure.
Yeah. And what about just sort of that transition? Because I've listened, I'm a big Premier League fan, football fan, and I've listened to a lot of sort of players over the years saying that transition actually from being in a sort of the camaraderie, being in that environment every day to then sort of maybe working in finance, which is still exciting, but maybe not as exciting. From a personal level, how was that?
Yeah, look, the transition's challenging. It sort of reminds me a little bit of what most people go through when they finish school and they finish one area of their life and move into another. I think one of the big differences is when you're 18, you probably get given more flexibility and freedom by society to explore, and you generally have less responsibilities than you do when you're in your early 30s, and you've you've got a family and expectations, you have a clear view of what you want to do. I think the big learning for me through that period was just really becoming clear on what I'm actually good at. And I'm amazed by how many people I see in various jobs or occupations that they're really not suited to, that they're doing it because they think they should be, or they're doing it to please their parents or their wife or whomever. And a lot of people just aren't overly clear on what their superpower or what their skill set is. So what that looked like for me was, when I finished football, I wanted to start an operating business because the business people I knew and admired the most, that's what they did. But managing large amounts of people, I don't think is really suited to where my strongest skills lie. I'm much more suited to exploring ideas in depth than managing large numbers of people. So once I really got that clarity, that was really useful. And then to really zero in investing, because, there's a psychology around investing, which I think suited to my disposition. I don't get swayed easily by outside noise. I'm naturally disagreeable, so I don't just believe any sort of lie that a CEO is telling me about what their company's going to do. And there's a competitiveness that comes with investing where we've got a scoreboard every day where we either win or we lose. And I really like that. And I like being able to explore ideas in depth rather than dealing with sort of HR problems and a large number of people, which other people just do better than me.
Yeah, absolutely. And that's a really good sort of lead in, I think, because you mentioned there about some of sort of the personal skills that you've got that, obviously helping you as an investor. What do you see then as some of the key parallels between being a professional athlete at, the top of the game to then being an investor? And do you think those experiences have actually helped made you a better investor today?
Yeah, I think so. I mean, some of the parallels are, in a sporting sense, no one's ever played the perfect game. So football is a game of mistakes, and you often see young players make a mistake and spend the rest of their game reviewing it and just sort of get paralysed analysing that mistake. And investing's got some similarities with that. No one except sort of Twitter influencers sell at the very top. No one buys at the very bottom. There's always something left on the table somewhere, or an opportunity that's been missed, or a crap opportunity that's been purchased. But, if you perseverate on those mistakes, you sort of miss the next opportunity that's staring you in the face. So we try and maintain focus on that like you would as an athlete, on what's going to happen next. What's, in a footballing sense, it's what's going to be your next contest. In the investing sense, what's going to be the next, investment decision that's going to create value for the unit holders. So we're really focused on that. But also there's a sense of not listening to odds when you play professional sport. You hear people talk about, it's nigh impossible for investors to beat the market. That's a common thing that gets spoken about. I mean, equally, it's nigh impossible for young kids to get drafted. If you look at how many kids are playing junior football across the country, the likelihood you're going to get drafted is wildly low. And then of those people that get drafted, the likelihood you're going to have a long career is, significantly low again. So you do have to have a component of not just listening to consensus if you want to be a professional athlete. And being a fund manager is no different. You're essentially saying that you're confident in doing something different to the market, and you're going to have an ability to outperform the market. Otherwise, why would the unit holders bother taking the risk on you? So there's some correlations with that as well, not just listening to stories that people tell you, because there's a lot of them in professional sport. Stories like people in their first year or two can't play well, ruckman take longer to develop, all these so-called truths, but they're really just opinions dressed up as truths, and it's dangerous to listen to them when you're an athlete, and likewise when you're an investor.
Yeah, I guess it's a big mental game in both, isn't it? Sort of trying to, like you say, sort of take away that outside noise and focus on where you want to get to. And a big part of that in investing is sometimes, you're not always going to make the best investments, but it's about, moving on to sort of that next one. Okay, Chris, before we get into investing, I want to fire a quick couple of questions at you. How does that sound? Super. Okay, so first one, best player you played with in your career?
I'd say Dean Cox.
Okay. Best coach?
John Worsfold.
Best investment you've ever made?
Yeah, I'd probably say my wife.
Worst investment you've ever made?
Oh, look, I probably won't. There's been plenty. I think what's really stands out when something's really poor is doubling up on a loser and spending good money after bad.
Good point. Favorite game that you ever played in?
Of football?
Yeah.
The 06 Premiership.
Amazing. And the first thing that you look at when researching a company?
I guess the first thing is what are the macroeconomic factors that are going to move that company?
Perfect. There they are. Some great points there. And we'll lead straight into that point there and talking about macroeconomics, because your fund does take a top-down macroeconomic view on buying equities. I want to dive a little bit deeper into sort of what that means. So I want to sort of, help our listeners understand, as I say, what that means, explain a little bit more, and also how you go about conducting research for your investments.
Yeah, so I guess what macro means, or what are macroeconomic ideas that we look for. They're long-term secular trends. So a secular trend is one that can last for longer than one cycle. And we do this for a number of reasons. A, it's just what we find interesting. It helps explain not just what's happening in investment markets, what's happening in the world. So whenever you're thoroughly interested in something, that makes sense to listen to that, because you'll naturally work harder on it because it doesn't feel like work. The other reason we like macro so much is because the vast majority of investors, particularly in Australia, are bottom-up investors. And the landscape here is really suited to really good bottom-up investors looking to outperform an index and relative trade stocks in that index. We don't want to be the same as all other investors. We want superior returns, so we're naturally attracted to doing things differently. If we follow the same process as everyone, it doesn't make any sense to us why we get different outcomes. So we like that. Yeah, and it's it's macro investing is often viewed as, but generally it means you invest in things like currencies, commodities, bonds, things like that. For us, we don't view ourselves having an edge in market timing, which often the great macro traders do. And we don't want to slap on more risk than we need to. So whilst we are a macro fund in terms of how we generate our ideas, we express those ideas only through equities. And we don't use any leverage. We don't short equities. It's just long only equities. I guess really because that's the level of risk we're comfortable with and we're comfortable our unit holders taking on. So whilst it is a macro fund in terms of idea generation, it's different to a traditional macro fund in that we don't use leverage and we express those views only through long only equities.
Yeah, brilliant. And in terms of that, when you look at those equities and you're taking that sort of macro research into account, do you have a specific focus on any sectors, for example? And if so, why? And then sort of a continuation of that is, how would you say a retail investor can apply a similar approach to their portfolio? Yeah,
well, we don't. Our focus on different sectors really is just what's interesting us in macro at any one moment. So we're not skewed towards having a bias towards a particular sector. There's some sectors we would tread carefully in. We find it very hard to invest in biotech just because it's so largely science-based and we don't have an edge there. We don't overweight commodities per se, but we don't avoid them either. But when we do invest in commodities, we generally try and invest in producers. We try not to take metallurgical risk around developers or too many developers, again, because we don't have an edge there. And when we do invest, let's say there's a theme we like in mining, like uranium, we'll generally look to express that through more than one company, because there's nothing more annoying than getting the idea right and the trade wrong because of something unforeseen. But yeah, we have a broad range of sectors. Some of the themes we like are, aging demographics across the Western world, currency debasement, uranium, increasing manufacturing capacity build out in the US, the electrification of everything. These are sort of really broad-based themes. And then we look at individual companies that can play into those themes that we think are going to be strong for a number of years.
Yeah, fantastic. So let's dive into the macro picture a little bit more, because it is a fascinating environment right now. We've obviously just had that first cut from the Fed, and it was obviously an outsized one. It was the market consensus, but still it was, still maybe a little bit of a shock. So on that, were you surprised by it, and what did that mean for you and the strategy?
Yeah, well, we thought the market was really being guided to a 50 basis point cut by the Fed. Nick Timiraos is largely viewed as a Fed mouthpiece, and he came out with an article that they would do 50 basis points, which was seen as very much a non-consensus view at the time, but that really started in process. And then you had previous Fed officials talking about the need for a 50 basis point cut. Felt like we were really being guided to that. I guess if you look at last week's non-farm payrolls, they came in far hotter than expected in the US. So you've got an employment market that appears to be potentially re-accelerating, and inflation's still not back to the Fed's target. It's moving towards that 2% target, but it's not there yet. So it's an interesting time to cut. It's an interesting time to do a 50 basis point cut. I think the narrative that doesn't get spoken about a lot is just what a huge sum of money the Fed needs to roll in bonds over the next 12 months. And I think that's not being spoken about enough. And, with the deficits being as high as they are, north of $2 trillion per year in the US, interest payment is the largest expense that they can feasibly cut. It's unlikely they're going to cut defence spending. It's unlikely they're going to cut entitlements and healthcare. Whereas interest payments, annually at over $1 trillion a year now, if rates come down, that's a place where they can get a significant saving and potentially not let that deficit blow out. Because whilst there's been a view that deficits don't really matter, we saw in England this year they eventually do. And, we saw Liz Truss move on after a deficit blowout. And I think the US would be aware of that and really conscious of not wanting an event like that happening over there. So we think whilst the Fed's mandate is to maintain, strong employment and keep inflation around 2%, we think their most important mandate that's not spoken about is keeping the US government funded. And, with deficits already where they are in a non-recessionary environment outside of a world war is really unheard of. And we think the rate cuts are as much to do with that than they are employment and inflation.
Yeah,
and that's a very different environment.
Yeah, absolutely. A massive factor to sort of really take into account. And, it could mean that we do continue to see those consecutive rate cuts, coming in over time. And again, I think even if we still get a 25 basis point cut and we get a couple before the year end, it would still be sort of, outside where we saw it from a dot plot perspective as well. And I think we get Fed minutes today when we record this as well. So it'll be really interesting to see the sort of consensus view on who sort of agreed with maybe Powell if he was moving for that 50 basis points as well.
I think that what's different is when they cut and there's a recession, it's a really tough time for markets generally. COVID being, if you go at what does the market do over the next 12 months, COVID being a bit of the anomaly, albeit it was super tough at the time, but 12 months later the market was actually up in the US. The previous two times, GFC and post-dot-com boom, when they started cutting, 12 months later the markets were still down significantly, but they were in a recession. If you go back further, if they cut and it's not a recessionary environment, which may be what we're looking at now, that's traditionally or historically, that's been a really strong time to invest. And that, that's our base case currently. So we think it's a pretty bullish time for equities, even though there are plenty of challenges and nasty headlines around.
Yeah, absolutely. Sometimes looking past the noise, isn't it? But bringing it back home, Chris, we're going to look at the RBA because they've been pretty hawkish still, really, in the last sort of couple of months. We've sort of seemingly on a different path, but again, in hearing from them, we are in a different period in terms of, the labour market, inflation. So what do you anticipate will be the RBA's next move? And are there any indicators that you're watching closely to sort of really give you that view of that?
Oh, we think the next move by the RBA will be down. We've got February, but we're not really attached to that view. I'm surprised more isn't being made of just how soft the Australian economy is. If you think of 2 negative quarters of GDP growth is a recession, 8 negative quarters of GDP growth is a depression. We've had now 6 negative quarters per capita GDP growth in Australia. So without migration, we'd be staring down a depression, not a recession. But just because we're stuffing so many new people into Australia, we've got GDP growth and we all need to pretend that the economy's reasonably strong. So I'm amazed more's not being made of that. And I think what it speaks to is just how much pain a lot of people in the economy are feeling currently. And so, I think the next move's down. But inflation's stickier than the RBA would like it to be. And again, when you stuff 600,000 new people into the country, they all need to buy stuff. It's hard for inflation to rip lower when there's so many more people, chasing shelter and food and services and electricity, etc. So, the one thing that potentially comes down in that environment is wage inflation, which is the only thing the average person actually wants. The rest of the inflation they don't want, that they're copying to the next. So I think it's a bit ugly out there. I think the headline numbers mislead the challenges being faced by a lot of people. But I think by Feb, there's every chance there'll be a rate cut in Australia.
Yeah, absolutely. And like you say, those migration numbers then as well sort of throw that volatility into the employment numbers that we've continued to see over the last couple of months as well. Chris, you were saying a minute ago that you're sort of bullish on equities in this sort of current period, given what we've already mentioned. It's still a pretty difficult time in some way to sort of navigate the market for retail investors. We've got geopolitical tensions going on. We aren't, exactly sure on the path of rates, although we know they are sort of going to come down. The Fed have sort of, the pricing of those cuts has changed quite a lot. So I wanted to maybe see if you had any insight for retail investors sort of really navigating the current environment.
I think it's such a challenging time, and not just for retail investors, just for all investors right now, because there is so much volatility and so much of the price action isn't actually to do with what you call the fundamentals. So much of it's to do with positioning, or the amount of options being used in the US market is something we've never seen before, and you see that throw markets around, particularly at the end of the month. And there's just a lot of things that are hard to predict. China, the Chinese economy has been soft for a long time. It felt like they were never going to pump in any stimulus. And then once the US cut rates by 50 basis points, it felt like that gave China the green light to implement huge stimulus initiatives, which, we saw their markets rip from the monetary stimulus announced, and then they pre-announced they were going to come forward with some fiscal stimulus, and then that fell short, and then we saw the Hang Seng drop by almost 10% yesterday. So I think it's always important not to get pushed around too much by short-term price action or volatility, but I think now more so than ever, you need to have a longer-term view, call it 1 to 3 years of what you think is going to happen, and invest for that, and sort of stick to the plan. If you just get pulled around by the headlines each week, I just think you're going to struggle in this market, because it is very momentum driven. And if you do get some bad headlines one way or the other, the market can really overshoot. So I think it just pays to be able to look through some short-term volatility and withstand some discomfort, as long as the longer-term things are looking how you expect.
Yeah, absolutely. There would have been many headlines that could have given reasons to investors to sort of sell this year, but we're still sat here near record highs for the S&P 500 that it sort of keeps pulling out.
I think it's always also good to illustrate, like, the economy's not the market. Mm-hmm. When even in my short investing history, I think the biggest economic crisis people our age have lived through is COVID. And what did our house prices do in Australia? Well, they were ripped 30%. So, we think liquidity plays such an outsized role in asset prices, and we think, one mistake, maybe new investors can sometimes make is thinking that the economy is the market, and they're not the same thing. We're bullish on markets right now. We're not bullish on the economy, particularly in Australia, but a softer economy gives more opportunity for central authorities to pump liquidity into the system. And so often when we see markets going up, it's not so much that the value of that market is going up for us, it's more the thing measuring it, the denominator, the currency is going down, and that's certainly what we saw in COVID. And when we get liquidity injections, we think that's what we'll see again.
Yeah, absolutely. So let's round it all off, Chris. We've covered quite a lot there. We spoke about the macro, we spoke about sort of your view on markets, but where do you see the most value for investors right now?
Look, we think there's a big opportunity in Aussie small caps. If you look at our indexes, the large caps and the indices have generally been pretty strong. And if you look at who's got money to invest in Australia, it's super funds. That money just comes in year after year. They've got money to buy, and companies that are large enough to attract that capital in Australia, as a broad group, have done pretty well. Companies that aren't big enough to attract super fund money, that rely on retail investment flows, have been absolutely smashed, particularly on a relative basis compared to their larger peers. So we think there's a real mismatch in valuations there, and we think that the catalyst could be when interest rates drop in Australia, when people feel their houses are going up again and they feel more confident to put money to work in the markets. That could be a catalyst for some of these smaller type opportunities to catch a bid, and we think they've probably got a bit of catching up to do compared to their larger peers. So we think there's a real opportunity there in Aussie smalls.
Absolutely, yeah, and it looks like that we already had that in the US, didn't we? That sort of rotation out of tech and into some of those. Yeah,
which we haven't seen as strong here. I don't think that rotation. We've seen it from particularly the Nasdaq to the Russell over there. It started in Australia, but we don't think it's been as pronounced as yet.
Yeah, absolutely. Something to definitely keep an eye on. Chris, thank you so much for your time today. It's been a pleasure having you on. Thanks for joining us.
Thanks, Josh. Great to chat.
To make sure you stay informed on markets, head over to the eToro Academy and stay tuned in to Conversation with Leaders to get the latest from the experts. Click subscribe and don't miss a beat.